Welcome back, everyone. Sean Stevens here again with Metroplex Mortgage Services and our divorce mortgage lending video quick tip. When divorce involves a self-employed borrower, mortgage qualifying becomes more complex. Unlike traditional W-2 income, self-employment income requires detailed tax return analysis, add-backs, and stability reviews. These features can significantly impact a divorcing homeowner's ability to refinance or purchase a new home. In today's post, I'll review how self-employment income is calculated for mortgage purposes, common pitfalls attorneys and homeowners should be aware of, and how divorce mortgage planning can help ensure settlement agreements are enforceable. But before we get started, don't forget to download our free divorce lending blueprint for success with the link below. This is a step-by-step resource designed to help attorneys and homeowners navigate the refinance and purchase process during divorce. From a mortgage qualifying perspective, a borrower is considered self-employed when they have an ownership interest of 25% or more of a business, which can include sole proprietorships, partnerships, corporations or S corporations, and limited liability companies. For divorcing homeowners, this distinction is critical. Even if a spouse also has W-2 income, their self-employed business interests can require additional documentation and analysis before income is considered stable and usable for mortgage qualifying. When taking into consideration the required documentation needed for self-employed borrowers, attorneys should advise clients early in the divorce process to be prepared with the necessary documentation. A typical lender review for self-employed borrowers will include signed and dated individual tax returns, plus all schedules for the past 2 years, business tax returns for corporations, S corporations, and partnerships, year-to-date profit and loss and balance sheets, which generally are not required to be audited, Schedule K-1, and verification of any distributions. Failure to provide this information up front can delay the loan process and may create settlement issues if refinance timelines are tied to court-ordered deadlines. A common question we receive is, how will self-employment income be calculated? Unlike salaried income, gross revenue is not the starting point for qualifying purposes. Instead, lenders will analyze tax returns and financials to determine an average monthly income based on net income after business expenses, allowable add-backs such as depreciation, trends in earnings such as declining income, which can raise red flags even if the business is still profitable, stability and likelihood of continuance of the business income, and a liquidity analysis, which will be used to determine that the business has sufficient liquidity for generating a consistent monthly income for the borrower. This is especially important in divorce scenarios where the division of business ownership can directly impact the income calculation. Attorneys should watch out for the following pitfalls when negotiating settlements involving self-employed spouses. Don't overestimate income by assuming gross receipts also equals qualifying income. This can cause major loan approval issues. Tax return timing. Outdated or incomplete returns can delay the refinance process. Business asset division. If one spouse loses their business interest, future income may no longer be stable or allowable for mortgage purposes. When a divorcing homeowner is self-employed, proper divorce mortgage planning matters. Mortgage qualifying can become a make or break factor in settlement negotiations. In working with a certified divorce lending professional ensures proper income analysis is conducted before settlement terms are finalized, avoid unrealistic timelines for refinance or purchase transactions, and help ensure that settlement agreements are drafted with enforceability in mind. By bringing a CDLP into the process early, attorneys can help their clients avoid last-minute financing surprises and secure stronger financial outcomes. And on a scheduling note, we're currently coordinating in-office and virtual presentations for Florida family law firms. Each session is customized to address equity buyout refinance planning, purchase options and down payment requirements, credit scores and debt-to-income ratios, and how to structure enforceable mortgage-related provisions. Just contact my office today to reserve your preferred date. And as always, I want everyone to make it a great day and look forward to seeing you right here for the next Divorce Mortgage Planning Video Quick Tip.